Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Adam Zott. He retired from civil engineering at 32 through real estate investing. He currently holds 50 single-family rentals in 13 different states, along with various alternative investments. His main passion, though, is helping dads with young kids achieve time freedom through real estate investing. So, Adam, thank you so much for being on the show today.
You're welcome, and I'm excited to be here. Excited to dive in.
So you have an interesting background prior to getting involved with real estate, which I think everybody kind of does that comes on the show, but you were able to become successfully free by 32 through real estate investing. Can you tell us just a little bit about yourself, both personally and professionally, prior to catching the real estate bug and doing your first couple investments?
For sure. Yeah, I grew up in a town of 17,000 people, so there's not a lot. So, kind of acres of diamonds here in North Dakota, a population of like 700,000 for the full state. So there wasn't a lot of excuses of capital and deal flow. So when I was a civil engineer, it was a decent paying job. I think it was like 75,000 a year of what I was up to. So for me, it was all about collaborating with other people. So I am a partner on almost any deal besides like two deals that I did personally. I'm always forming new LLCs. I think I have like 7 LLCs. And so for me, it's all about how is it 1 + 1 = 3. So that was the way that really allowed me to go fastest the furthest. Cause like I did two myself over a period of 5 years. But then after that, it was, okay, let's really dive into here. How can I find someone that complements my strengths and my weaknesses?
And how did you find that person?
So for this particular one, it was someone that was doing construction, happened to be looking to get into real estate, but was really kind of just a friend. And so I've had deals that have gone south. I've had equity deals where it's gone really well. So I've kind of seen both. I know Dave Ramsey's always the only ship that doesn't sail is a partnership. And so I think that's true where it can go both good or bad, but I kind of think of it as a marriage too, where it's probably higher risk, higher reward. But I'm of the adage, if you want to go fast, go by yourself. If you want to go far, go with someone.
Yeah, and I think the thing with Dave Ramsey, because when he says that, it is true. I get it. I think because it's true, and he always puts a caveat on that for people that are in higher education professions that have partnerships. So attorneys, accountants. Why? Because they're actually probably going through the actual process of vetting and going through that everything. And I don't think you have that with a lot of people in real estate, which is in business in general. I think it's just like, oh, we met at a conference or we did here, and this sounds fine. And then you find out later it's not a match because you didn't ask the hard questions up front, which I imagine the ones that go 10 plus years do.
Yeah, and I think the rule of try to give your partner the better end of the deal, if you just end up doing that and you kind of put the ego aside, a lot of times there was probably multiple times where similar to my spouse, like I was having conflicts with my business partner, right? It was like, oh, he's not dreaming big enough, or I'm doing sales and marketing and he's doing operations, and like who's actually more valuable. Once you get over that and you're like, man, like how awesome my life is, without him. I realize that maybe at some point, there isn't that, but I feel like there's kind of a quick division of labor. So I like to, similar to, I keep coming back to kind of marriage stuff, but I like to date, get engaged, and then get business married. And so I feel like that's a great way of doing business partnerships, is to just get to know each other, do one deal together. Do you like each other after that? Okay, then maybe form the LLC, start with a joint venture, do something like that where you can actually test out someone, go over a period of like a year, see the full season, the full cycle. Is there anything else going on? Is it just a flash in the pan and then they're off, doing something else? What happens when things get hard? What do they do? And then from there, it kind of, grew from there. So I've gotten extremely fortunate that my first business partner, who we didn't really have like the formal agreement, that I've done, past, where it's like similar vision, but complementary skill sets, or similar values, complementary skill sets, which is kind of like now at least the standard that I currently use, which is like, extrovert, introvert, sales with operations, and vice versa. We just happen to work really well, where he's now kind of COO and I'm CEO.
Yeah, that works perfect. I mean, I remember the first property I bought decades back from a real estate investor and his partner, and we're at the closing table there, and he and his partner, and he was telling me about his first partner and why it didn't work out. And it was because he was like in his 20s and his other partner had money, but was like 30 years older than him. And so obviously you have different things going on in your life versus, a guy in his 20s that's hungry out there or whatever, finding deals. We're pushing off everything to the end to get paid, and this person's like, well, I'm already there already, so like I don't need this. And that's why it didn't work, because you had different timetables of what you're doing. And so I found that really very interesting. And one other thing too is I found that you don't count your partner's money, And I think that's really important when you're partnering people, no matter how you're getting deals done, whatever industry you're in, either. You know what I mean? If you're splitting profits one way or another, and you might say, well, I think I'm doing more than this. And that's kind of like a black hole. You know what I mean? You got to be like, listen, I'm doing what I'm doing. I'm getting paid what I was supposed to get paid, what I agreed on. And that's kind of how this is how it's set up. And we just need more, whatever we're doing to make more money. You know what I mean? And I think when people start like trying to cut people out or do stuff, I mean, that kind of thing is the beginning of the end for really partnerships.
And it's so fun how I feel like sometimes it yo-yos where you're like, man, like I'm doing this and he's not doing that, but then like 6 months later it'll flip. I'm like, oh, I'm on a weekend vacation and he's just running the entire business. I was like,
Yeah.
you know what, that's really awesome. Or it's like, all he does is the financials, and it's like, oh, thank God he does the financials, right? So it's like even myself. So like, I totally agree with you, Charles, where it's like, yeah, you if you start getting down that's a very dark hole.
So kind of, I'm not sure if you touched on it, but it's one thing I always like to ask, how you chose real estate as your investment vehicle, because there's so many different things people can do out there to make money and, quote unquote, reach financial freedom, whatever that might be for each person.
So I did both theoretical, but I'm more practical. So like, of course, you can read the books, and that the majority of people make their become a millionaire through real estate. So like that was one stat that that was super beneficial to me, and like I kind of heard about it, did the Rich Dad Poor Dad, all that fun stuff. But then I was like, ooh, I tried stocks, day trading, fantasy sports, developing my own product, and real estate. And so like I basically failed as fast as I could in those ways, and it was like, oh, but real estate was the one that was the least bad, right? Like the product was like, oh, this didn't really work, and it take a bunch of capital to do all that. Tried day trading. I was like, you get lucky for a little bit, then you just lose everything. You can do long-term investing in stocks, but it's like, okay, well now I don't really have a unique advantage, and I can only read so many, scripts and profit and earnings. And I was like, I didn't really think I had an unfair advantage. I was like, oh, real estate was the one I was like, I'm actually valued for insider trading. Like I have a great combination of like I can invest in my backyard, I can do sweat equity, and I can like actually improve the value of it. And so since I did that and I was able to see, and so that's kind of my philosophy is just find five dominoes, flick at all of them, whichever one falls over, just like keep going down that path. So then it's like I go down the real estate, I kind of revisit the other ones where I was like, you know what, this one worked. Okay, now do the next real estate. But then it was like another series of five dominoes. Okay, should I do storage units, single family, multifamily, this? And it's like, okay, try to knock on all those. Okay, I tried multifamily, didn't work for me. Okay, try the single family. Okay, it still worked. And then it was kind of niching down, and then eventually got into rent to own. And now there's another five dominoes of whether it's a fund, if it's capital raising, what markets, all the different things, all within that same niche. And so I just like the idea of flicking a bunch of dominoes, seeing which one falls, and then just continuing to go down that path.
Yeah, it's always an interesting part. I realized it in my second property, that I had done that one correctly, and I was like, okay, now I see how this like business actually works. Because the first one was like, I didn't do it correctly. I didn't know what I was doing. And the second one, I had a little bit more knowledge of what I was doing, and it kind of went from there. But what mistakes do you think you did on your first couple properties or your first property, that you take with you now, some advice, and maybe when you're talking to new people, new investors, that you let them know about?
Sure. So my first two properties, I feel like I got pretty lucky and did okay. First one was a house hack, so I rented it out to my roommates. I was like, that's like it's really hard to screw that up. Like so that's just easy. The next one, I bought a 3 bedroom, was going to turn it into a 4 bedroom bath, but I actually was showing one property and they just filled the other property. So then they stayed in there for 5 years. So I got really lucky on that one. Third property, then I finally was like, oh, I bought this 1904 house thinking that I could put like 10 grand into it. And I was like, oh, that got me one window. And I was like, I knew nothing about 1900s house. So it cost about 3 times as much, 6 months of, extra time to get into it. So it was kind of a black hole. But I was like, but that was the one that's like, oh, and now I'm never going to do that again. Because the only way I can meet, Brandon's Turner 12% cash on cash was to buy a really old house that rented for a high amount. And I just forgot about CapEx, right? I just didn't think of that. You could put in 10% or whatever the number is. I'm like, oh yeah, that'll cover me. But it's like, well, it's really not the same on a new construction versus an old one. Tried some turnkey properties, tried some for sale by owner ones where like we were self-managing it. And so it just kept being like vacancies killed all the profits. So I was like, okay, how do I not get vacancy? So those are kind of the early lessons on capital expenditures and then how much vacancy impacts yearly profit.
So you said your third property was older property. I started with properties built 1900, 1904. I know all that. I know that whole game. So what was their first two properties that worked well? Approximately when were they built?
So the first one was in 1993, and the next one was in 1983.
Yeah. So, yeah, completely different ball games. Yeah,
Very
because
different. Yep.
you don't have to touch any of the bones most likely on the property built in '90s and '80s, most likely not either. So it's like that changes the whole ball game because now you're focusing more on like maybe cosmetic stuff and not so much on repiping and rewiring houses. You know what I mean? Which doesn't add rent to your bottom line, really. NOI, because people aren't going to pay more that their light switches work. So
No, yeah, nothing infuriates me more than putting in $30,000 into something that no one cares about. Like, oh, let me get a new sewer line. Like, oh yeah, like just the worst kind of things, right? Where it's like no one sees any value in that. Like you're not putting that in the MLS description if you're reselling it. It's just like just money that just seems like it's flushed down the toilet.
yeah, literally, literally.
Yeah.
So can you explain? Because I mean, doing some becoming having some rental properties, which are extreme right now, is a great start, but it's much different than actually becoming financially free. So, can you kind of like break down a little bit about how that process was? You went through, you found something that worked, a strategy that you had an upper hand on, and kind of like let us know kind of how you kind of exploit that a little bit, and were able to kind of grow to where you are in a short period of time.
Sure. So the first, I would say, two properties I did myself, just kind of saved up, put the 20% down. It's like, man, I run out of cash pretty quick. Then you form a partner, and now we each only need to bring 10% down. And so then, like, you could buy a few more properties, a little bit quicker. But I was like, man, we're just going to keep running out of capital. Like, you could. And so our goal was two properties a year for 10 years. And if we could do that, we are like, and then you buy two and sell two, then you buy two and sell two. It was like, and then the math kind of worked out where we could each get $10,000 a month. If we were able to get, $300 to $400 a month in cash flow, they appreciate over 10 years. You sell two, you buy two, like there's enough of that equity gain where it's like $10,000 a month. So that was our goal when we formed the company, in 2017. Each of us getting $10,000 a month is kind of like the magic number of, whether it's entirely passive or like, hey, I'm working 10 hours a week or whatever the number is, just to kind of keep things going. And so that was the intent. So then it was like, okay, we kind of maxed out our capital. So like, okay, how do I get the highest ROI then? So now it was like, well, we could look at the burn, the fix and rehab, but like, we really didn't want to do that. So what we ended up doing is, finding college kids, pick a house that was listed for sale, and then we'd buy it for them and they'd rent it to us at the 1% rule. But we would do a huge seller credit on it. So if it was listed for 200,000, they would rent it for $2,000. So in general, is the 1% rule. Then we would offer $215,000 on it with a $15,000 seller credit. Use a commercial loan instead of a residential Fannie Mae loan. And so to the bank, it didn't mean a whole lot, but for us, it was $15,000 or $13,000 less cash needed to close on the transaction. So that was one way that we kind of maximized our ROI by just putting less than 20% down. Then we did that for a few college kids just to kind of get the higher ROI. And then we started doing the lease with an option to buy, where now our tenants come in with somewhere between 10 and 20% down. We're coming in with whatever's the remainder. So now we're only putting, 5 to 10% down on a property. So now I can do about 4-to-1 ratio on the capital versus what I was doing when I was putting 20% down myself.
So this concept. It's really reverse investing, I think, is kind of how you coined it. How is this? You have a lot of benefits right there you mentioned, but how do you find this as a better path to real estate investing versus the traditional approach that you just outlined of 20% down and going that route?
Yeah, so I think if you have nothing, or if you're just looking to buy properties, like there's still nothing wrong with the 20% down. Like any to me, any purchase is better than no purchase. And so like just with that caveat, so I just feel like if you're going from 0 to 1 to 2 to 3, like definitely do that. If you're just trying to get one, like you don't have to get fancy, just do something. Like that's probably the biggest advice. But for us, it was like, okay, how could we, instead of finding the property and hoping I'm getting rent or market rent, it'd be like, oh, how do we reverse that? How can I find the person first and the property second? And so that's the whole concept is like, I was like, man, banks make so much money. How do they do it? Well, they basically borrow money and do a yield spread. I'm giving them, money, we're getting 2% and they charge 6%. And so I was like, okay, so if I'm borrowing at, call it 6%, how could I get 8 or 10%? And it's like, okay, well, if someone can't get a bank loan, then I'll basically back it. I'll be their personal guarantee or their signer. And then based on how risky they are, I'm just charging a spread onto it. Very similar to what the bank is, but the bank is playing with, I can only lose one out of every 1,000. And I'm like, you know what? If I'm an investor, like I'm a little bit more savvy. I can take a little bit more risk, so I can take kind of a higher yield. So it's almost like probably whatever the bond rating would be. It's like, oh, we're finding people that don't have the debt to income ratio. Maybe they have a down payment but don't have the credit score. Maybe it's they went through a divorce or they went through something else. And so now it's like, okay, not only can I be a co-signer, but it's like, okay, I basically issue them the equivalent of a pre-approval letter that a bank gives me, but I just give them a rent-to-own pre-approval letter. Go pick a house over 300,000 as long as you're putting 10% down and you pay the 1% rule or whatever the number is that I've pre-approved them for through kind of like our underwriting process. Then they get to go pick a house. I'll buy it for them, and as long as they're putting the 10% down, to me that's like, okay, well I got 7 months of extra rent in the bank as opposed to 1 month's rent. And then we add on rent guarantee insurance, do a couple other, creative things, just similar to the banks, how they have private mortgage insurance. We apply rent guarantee insurance, make the tenant pay for that if their credit score is, below a certain threshold. That way it'll cover for an additional 3 to 6 months if they stop paying. And so all we're trying to do is act like the banks, where it's like heads I win, tails we break even. And so then it just do that and then do it as many times as you can.
Yeah, it's also a second thing is that you're not selling this on the secondary market. So I feel that a lot of banks with certain loans, they're gonna kind of bundle these and sell them off, right? Maybe not with some of their small commercial loans; they'll keep those on the books, but some other ones they probably will. So I think that's why they need it to fit right in this box so that it can easily be packaged and get off their books. And so you can be a little bit more I guess flexible with what you're doing. But can you explain, just you went over it pretty quickly there, but how does the process work from the beginning to end? So if I am somebody that can't get approved for a mortgage, I go to you, I find you one way or another, and then you're pretty much pre-qualifying me and kind of go from there.
Sure. So if Charles is like, hey, I just recently left my corporate job. I started this real estate, thing. I have rental properties. I'm maybe a real estate agent and I'm making $150,000 a year. And I want to buy a single family home. I don't want to rent. I can't get a mortgage because they said I need 2 years of tax returns, but I got $50,000 sitting in the bank. Like, why can't I get a mortgage? And Adam would look at you and be like, I completely agree. Like, to me, I would bet on Charles, right? And so for me, it would be like, okay, Charles, if you got 50 grand to put down on a home, I would say go pick a house, up to 500,000. And then as long as one third of your monthly rent is basically of your gross income, so kind of like the 30% front end ratio that like the DTI uses, I would say, okay, so if you're making, $12,000 a month, make sure your monthly payment isn't more than 4 grand a month. But if you're willing to pay 4 grand a month, put 50 grand down, go pick a house, for 400,000, and I'll buy the home for you. You're paying $4,000 a month. Maybe $400 to $800 of that is coming back to you in the form of equity, all of your down payment, and then you have a fixed buyback price at a 4% appreciation rate anytime in the next 3 years. So that if it goes above 4%, you keep it. If it's at 4%, like that's just my return on my investment as an investor. So then for me, I'm getting a 12 to 15 to 20%, cash on cash ROI. I feel like I'm hedged a little bit because you brought in 50,000, I brought in 50,000, into this transaction. And then once you go to buy the home, hopefully there's, additional equity into it, or I get my 4% premium. I don't get, a 10% or a 20%, but I just get a very basic 4% appreciation. And then that way it allows you to kind of have some market upside, cap if it does go that route. So there's a few more nuance that way, but essentially you would pick the home, I would be the buyer, and you would pick because we're actually picking homes listed for sale with a real estate agent. So you would go shopping in Atlanta, Georgia, Tennessee, wherever it is. And then just virtually, we just write the offer, give our pre-approval letter from our bank, submit the offer. And then the same day that we close, we execute the lease with an option to buy with what would be the tenant.
How long is that lease option to buy usually?
We usually give people 3 years and then the ability to extend another year, but we're typically getting commercial financing, which is like 5-year fixed. So that's why we kind of give people up to, maybe 4 years, but we really don't want to go past that because we don't want to be in the situation where we, can fix a rate for 10 years because we don't know what our rate's going to be.
Yeah, no, that makes perfect sense.
And then in addition to that, became a mortgage loan originator in 2023. So kind of understand what Fannie Mae, what Freddie Mac, what the underwriting, automation system is looking for. And so the whole goal is you should be within 3 years be able to get mortgage eligible. And if you can't, like there's usually some other factors of spending or something else going on.
Now, you touched on it there in regards to the appreciation, which is something a little different that I haven't heard from before. So, can you explain a little bit how that works? So, say I buy a house for 400,000, I put $40,000 down on it. You purchase it, I'm paying you this mortgage every month, and in 3 years, I'm going to buy it from you. So, say it goes up, 5% a year. How does that work?
Sure. So two quick things. When you're doing rent to own, there's actually I call them quick three buckets. So if it's true seller financing, that's when you as the person living in the home is on title and the seller's in first position. Then you have what's called a land contract where the seller still is on title, but you have equitable interest in it and it's an interest rate with title. So you're actually paying like the equivalent of principal and interest. And then there's lease with an option to buy. So the $4,000 is technically rent. Now, if I want to live in a home, I want seller financing or contract for deed. If I'm an investor, I want to sell my home on a lease with an option to buy because I still get to depreciate it. If I have to, if I need to get someone out, it's an eviction versus a foreclosure. And so depending on what side of the fence you're on, there's some negotiating tactics, but those are kind of the three main vehicles that kind of the creative financing space works. So we set up most of ours on lease with an option to buy just because it protects the investor a lot more, because a foreclosure could be 3 months, 6 months, 9 months. That gets a lot more dangerous, where you basically need 20% down. Otherwise, like your risk is just too high. So in general, kind of with that said, it's a monthly payment, but you do earn some version of an equity credit every month. But let's say that every year you can buy back the home. Let's say we just used like a standard 4% appreciation rate. So after 1 year, it's 416. Then your buyback price is 432, and then it's 448. So let's say you exercised it at the end of 448, but the home appraised off at 460 because it appreciated by 5% every year. So your balance due would be your buyback price, which was call it the 436 minus your 40 grand minus, your rent credits. Let's say that there's another 12 grand in there. So your kind of net number is 388,000. The home appraised out at 460. And so that's your kind of balance due. But the way that we set this up is we want all of your 10% to be counted at it. We don't want you to have to go buy a home then for 388,000 and come back with another 10%, because that would defeat the purpose of you putting down 40 grand in the beginning. So we just count that all towards it so that you would essentially get a mortgage for 388,000 or 390,000, depending on how the equity split works. You don't have to come with more cash to the table.
Interesting. So yeah, that's very unique. So pretty much, I am going to be rolling in. I'm paying you part of your return up front, and then on the back end, I'm paying part of your return, which is really going on the back end because I'm putting it into a mortgage. So yeah, okay, very interesting. If you have money sitting in the stock market and you're worried about it, or worse, you have money sitting at the bank not keeping up with inflation, my name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So let's talk about from the investors. I understand from my side of how I do this, it works perfectly. Definitely, there's a lot of people are self-employed, I imagine, is where your bread and butter is on something like this. How are investors protected in this rent-to-own arrangement? You talked about it quickly about how you purchased the property, and if someone's in your position, how do I make sure that I'm buying it today and I'm also getting it rent? You're not stuck in the middle with a house.
Yeah, and so if I just land the plane on the tenant side, or I call them tenant buyers, on that one, to me, we did a podcast because I think rent to own's got a bad rap, rightfully so. A lot of people are like, give me 10 grand, move into this house, and then they just kick them out and they do it again. They do it again. It's a great financial model, but I think it's a terrible, ethical model. And so what we try to do is educate tenant buyers and be like, you know what you probably should do is just rent, fix your credit, or wait till you can get a mortgage, get 3 months, 6 months like that. That's the more traditional route and what we educate a lot of our clients on doing. It's for the people that are like, I don't want to move twice. Here's this home. I've either been living in it or I have a certain window. I don't want to, go through a different options, or this is the house that I want. And so we're basically a premium model where, hey, that the rent's higher, that you have a buyback, almost kind of like the equivalent of origination. So we just know that it's a premium model, but they're paying for that convenience to be able to pick a house listed for sale and have an exclusive option to buy it back at any point, rather than just picking a rental and who knows if they're going to be able to release it or do some different things. So once we've kind of identified that that's that target market where it can be a win-win, then it's okay from the investor side. You're essentially getting it at a lower LTV because normally you're buying it at market value or whatever you and the tenant agree to buy, but the tenant's coming in with 10% down, let's just say in this scenario. So you essentially got a property at 90% LTV and then you have a loan at 80% LTV with you having 10% in it. So like just from that math in itself, you're essentially buying the home at a little bit of a discount. Of course, if they buy back the home, it's a win pretty much no matter what, because you've built in, of course, if you bought it for 400 and sold it for 400, that doesn't make a lot of sense because you're just, in real estate, if you buy it for 400, sell it for 400, there's just not a lot of, profit there to be made. It's just like whatever the small rent is, but you got to cover, transaction costs, closing costs and different things. So in my experience, anytime a tenant exercises their option and purchases the home, it's a win because you could add 1% a year, you could add 5% a year, you could add 10% a year, you could just do a flat 10%. Some people just do it on future appraised value, which I like less, because if you just go tell someone to get an appraisal on a house and they have no purchase price to go for it, like plus or minus 50K, like just pick your appraiser. And so that's why we really like a very structured, here is your buyback price at any point in the next 3 years. So there's some really large companies that do this. Home Partners of America, Divvy Homes, Landis. Like Divvy Homes raised $500 million. Home Partners of America just got bought out by BlackRock for $6 billion, or just bought out maybe last year. And so they have 30,000 properties across the major metros. And this is their entire business model. They just tell people to go pick a home in their major metros. Any property built after 1979, they'll buy it. And then the tenant can exercise their option and buy it or not. And Home Partners of America doesn't care. They just say, give me 2% down, because all they want to do is accumulate rental properties. So whether the tenant exercises their option or not, Home Partners of America, just because they're doing it at a large enough scale, is like, great, I got a tenant for 2 or 3 years, I got a great property, and now I can just rent it again and move on that way. So depending on the risk profile of your tenant, the biggest leverage is how much of an option fee or a down payment that you're going to do. So we've screened over, I think, 500 tenant buyers, like the people that don't qualify for a mortgage, or the people that, if they do, we just tell them go get a mortgage because you don't need us. And so we've basically kind of created kind of like an underwriting criteria where we've seen these patterns of who purchases the homes, who doesn't, who's higher risk, and then we kind of approve them on an LTV, very similar to what a bank would do, but just on the rent to own process. And so the only way that the investor loses money is, one, the tenant doesn't buy the home, and then two, they sell it at or below what they bought it for. So if the home didn't appreciate, or, God forbid, you have to put in, $40,000 in repairs or something like that, because I get the tenant could, completely destroy the home, but so could a normal rental. But you have their down payment to offset that. And then typically you have home appreciation to offset that with. So there are some homes that we've, bought and sold. We've had, I think we're closing in on 100 single family homes. We've had 30 people go the full cycle. 2/3 of them have bought it, 1/3 of them haven't. And then every time we learn that, we just get smarter as we buy new homes for people.
And so you're limiting that having to sell the home again, right? Is that what you're saying? Yeah. Cuts down a lot on your hassle and also on fees, I would imagine.
That's right. Because like when we buy a home for a tenant, we're like, I don't want this house back. Like it is not in my best interest for you to not exercise this. So I'm going to do everything I can for you to buy this home, which I feel like is the intent from the very beginning. But of course there is, like, if people just don't pay their mortgage, don't pay rent, like then there has to be some pretty tough decisions. And so that's the model that we use to then accumulate 20, 30 properties, which was enough of a cash flow for both my business partner and I to kind of leave the job. And then it was like, okay, instead of us just owning all of these, because we had a lot of people wanting us to buy them homes, we started then giving them to my fellow engineers, family members, investors. So then we just started assigning the properties. So we'd find the tenant, we'd find the investor, we get it under contract, then we'd assign it to an individual. They get the cash flow, we get an assignment fee. So now we were kind of like wholesaling MLS deals on a rent to own because we found that the tenant was willing to pay a premium and that the cash flow made sense for the investor. And then eventually the investors just said, why don't you just create a fund? And so then we ended up doing that.
Makes perfect sense. You talked about it before, the screening of the tenants and the renters. How does this? How do you like? How in depth do you go? And then you talked about. I mean, what do we have like for losses on this when you're doing this? I mean, I would imagine it's much lower than a regular tenant for getting damages to the property. But if you just don't mind going into a little bit about your vetting and kind of maybe losses that you've personally had on these properties or people that you've worked with.
Sure. So the vetting has started off from just like, oh, just use a third party. And then they do the screening because like that was just super easy. Like you'd use apartments.com, you use Hemlane, you'd use, Rent Prep. And it's like, oh, here's the information. Okay, great. And then you make a decision. I was like, oh, turns out if you're buying someone a house, I'm like, I actually want to look at them almost more like a mortgage. And so we actually transferred from rental to mortgage, but we actually probably have one of the most um, difficult applications because we're looking at past rental history because I think that's important if they've ever got evicted or different things. But then we're also, looking at them from a debt to income ratio. We're pulling a full credit score. We're looking at liens, judgments. We've got their full credit score. We got their income. We're using automated, plus we're getting tax returns and bank statements. So it's probably, that's probably the biggest pushback we get is because we're just asking for so much information. But that's because they're already in this unique box. So we're trying to get as much information as we can to give them the best answer. If they're just like, yeah, I make some money and I got decent credit. I'm like, okay, well, that doesn't mean much to me. And so, and of course we've learned that because when you say talk about the losses, so we've had some where our investors have lost some, but most of them is when we bought them ourselves. We started off doing a lot of land contracts. And then I noticed that once someone stopped paying, I went to an attorney. It's like, okay, now what do we got to do? They're like, oh, well, you have to foreclose on them. And I was like, oh, what's that like? They're like, oh, well, here's this 9-month process for you getting the house back. And I was like, man, that really killed ROI. So we had several land contract deals that went south that took a long time for us to get back, where we took the hit as the investor, which is like the risk, right? Like somebody gives you $20,000 down, but even that, you hold the property for 9 months, and then the condition that you get it back in, like that time didn't help, a lot. Like that didn't offset the home appreciation. And then there's some where the family gets divorced, there's a death in the family, someone loses a job, and they just say, hey, like I'm out, like take the house. And if it's been like 3 months, it's like, okay, well, now you got to just sell the house. And they, you bought it at 275, you sell it at 275, you pay an agent 6%, you maybe put a little bit more into the home. And it's like, okay, well, then you lose money that way. So there hasn't been, like maybe more than a, 10 to 20%, negative ROI. And what we pride ourselves on is we've tracked every single deal that we've ever done. And we have expected profit, actual profit, and then current deal portfolio. So we kind of keep it in a running sheet of every single property that we've ever done, any property that we kept ourselves, assigned to other investors, or that's in the fund. And then we just got a running average that we openly share with our investors and be like, hey, here's the 6 deals that didn't make money. Here's the 6 deals that made the most money. Here's the average. Here's the ones that tenants didn't buy. Here's the ones where the tenants did buy. Here's all the different states, because we're in about 30 different states that we're buying across the Midwest. And so all that's just kind of feeding into our machine as we're kind of this younger company, because we only started this in 2019, to kind of fuel us and just get us smarter. So there was a lot of 2020, 2021, that we kind of figured out. But then there's also the benefits of homes that we bought in 2020. The tenants got just an incredible amount of equity in the home after they locked it in for 3 years, just because of what the home pricing did.
Yeah, no, that makes perfect sense. So for your personal portfolio, how do you? Let's talk about like the management on this. So servicing, I guess, is more of like loan servicing almost, or compared to being a property management.
Yep. Yeah. So on any of these deals, we are, well, I say we, but my business partner, because he's doing it all. He's just self-managing everything. And so it's like, And I was like, oh, we should outsource that. We should do different things. But it's like, well, the tenant's responsible for, repairs or maintenance or, almost all of it. So it's really like a loan servicing. So it's like, if they pay, great. If they don't, you go through the local attorney and they handle different things. And then if you really need some boots on the ground, we'll just hire our agent, whoever we use to buy the home, and just say, hey, are you interested in listing this home? To which they're like, pretty please, like I'll take double commission on a property. And then they'll usually, have local handyman, have different things to be able to, kind of rectify a situation. So if we need someone locally, we can go that route. But in general, it's pretty hands off. But I'll admit that he's a saint for being able to do that, because he's able to track all those properties.
Is that a full-time job, or is that more part-time lifestyle kind of?
Very, very part time. It's just the check in. I mean, if 80% of them or 90% of them are on time, like, you literally have to do nothing, right? Because they're all just set up on auto payment. There's nothing really going on, maybe besides keeping property taxes and home insurance up to date. It's just the 10% that are delinquent, where it's like, are you going to pay? How can we work with you? Let's set up a payment plan. If it gets too, like, we can have our own process, like 30 days late, okay. 60 days late, we're starting something. 90 days late, you're out. Which we feel like is fairly reasonable, rather than just trying to keep them out 30 days late.
Yeah, you want to kind of it's like with people that purchase loans, as I understand it, and or notes, and they are, they're trying to fix it, bring the person, current, and kind of go that route. So you're kind of doing that in house, which hopefully isn't that time consuming for you. One thing that you mentioned earlier on was that about some sort of tenant insurance or rent paid insurance. Can you explain what that is and how that's worked into everything?
Sure. So there's three companies. There's the guarantors, there's Leap, and then there's SureVestor. So just imagine you're placing insurance with the intent that if your tenant defaults, they'll cover X amount of lost rent. And in general, where tenants are screening like the default rates like less than 10%, insurance products are just like banking on there being less than more. And so what with this being our highest risk, I call them higher risk tenants, even though they're putting higher down payment, like the biggest risk is if they stop paying. And so what we do is we place multiple rent, coverages, which just basically says, hey, for 6 months after up to 6 months, after they stop paying, like, you continue to get paid rent, so that until you re-rent it, until you sell it, you don't have those holding those vacancy costs, and then they'll cover X amount of legal fees, X amount of repairs. So it's like, it's kind of just hedging your bet against, like, hey, if they do default, this is just an insurance policy against them. So those are the three. The guarantors probably has the most comprehensive. They have their own criteria, but it's probably the equivalent of 1 month's rent. So like a security deposit that you would pay up front. So if they're paying $4,000, like, you could pay $4,000, you could pocket it, but for us, you're basically paying $4,000, which a lot of times we'll just pass on to the tenant, especially if they're riskier tenants. We just say, hey, this is a cost because you're below a 580 credit score. Like, you just need to pay another $4,000, cover this rent guarantee insurance, just like you would with PMI on a mortgage. And so that way, if they default, we have $30,000 of buffer to cover lost rent, damages, and evictions, which to us, like, really should negate the downside of a lot of things.
Yeah, no, that makes perfect sense. One thing that I want to ask is, what do you find that people are lacking that are doing business with you? Are they lacking the set 2 years W-2, nice and clean pay stubs? Are they lacking a credit score that's up to a certain amount? I mean, if they don't have income, this doesn't work.
Yep. Yeah. So we started off with our minimum income being $4,000, then it was $6,000, then it was now I think it's up to like $8,000. So it's essentially for high income earners. So it's like, if you don't make over $100,000 a year and have at least 40,000, we're probably not your candidate. Which I'm now creating another startup with the intent of helping the 100,000 or the 200,000. But just from our business model, there was a lot of people in the 100,000 or 200,000 range that would just, for lack of a better, like, default. Like, we would get 10,000, which is 10% down, but like, that doesn't really offset a whole lot. And that lower price point, like, not that people don't care about 10,000, but when someone puts down 40,000, it's really hard for them, to walk away, or for the investor, kind of to lose money on that scenario. And so that's kind of what's been our new sweet spot, is kind of maybe the 300 to 500,000 purchase price range, where we're doing this. But to answer your question, it's probably 50-50, but it's like, they all have the income and they all have cash. It's just a credit score or 2 years of tax returns are the one and the two.
Yeah, the documentation that makes perfect sense, especially with a lot of people being self-employed these days. Um, so as we're kind of wrapping up here, I just want to add a couple questions here that we normally ask. I mean, what are common mistakes maybe you see real estate investors make? You've been doing this for many years in real estate investing, and as you said, all different types of asset classes, and where you are now. What do you see for that?
Sure. I would say number one is just not acting. I would rather use the Tim Ferriss where he's like, I could pay $25,000 and get a master's, or I could put 25 grand into a property or start a business and just assume that I'm going to lose the money, but I'm going to have a year's worth of education and hard knocks. So it's like, put the capital to work. If you do have 100 grand that you're looking to put to work, I like to put it in 4 different investments, $25,000 each, figure out which one you like. Put some into commercial, put some into storage, buy one property yourself and then do a turnkey. And then after that, like if you really don't know what you want to do, you'll figure out pretty quick which of those $25,000 investments that you really like. And then I would just go, further into that. The next piece is probably, it seems like getting access to the good deals almost only comes from networking, but I have a hard time sometimes with networking because it's like I could sit and meet with people all day, every day, but you don't really know which ones are, the right networks or how you do this. So for me, I found that joining groups has been super impactful to me. So like I'm in multiple dads groups, multiple entrepreneur groups, multiple real estate groups where it's almost like a pay to play, not necessarily pay for, for the intent of doing deals, because that's not, the intent, but it's like, just imagine someone's willing to pay $10 to get into a bar. It's just like that level of people that you're surrounding yourself with, they just value growth and what they're putting their money into. So I don't advocate starting there. Like the lowest cost, like great, like audiobooks, free stuff, podcast. Like I started that and I did all of that, but then I noticed like, oh, like you kind of hit a cap. You're like, I'm actually looking for meaningful conversations with high caliber people. And so I'm currently paying for 4 different masterminds. I got a coach, I got different things. So it's like just getting around those people, because I don't want just the normal social media feed. I want the social media feed of people that are, above my game or my peers, from that aspect. And so that would be, I would say, the 3 common things: that they don't get the network, they don't act, and then they don't, spread around their first investments. And then I like the idea, depending on if you're going truly passive or active, like once you're going truly active, like know your niche and know your people and hammer on that niche.
What did you sacrifice, do you think, Adam, to become financially free?
I sacrificed probably 4 things. One was news, just got it out. 2 was a lot of TV. 3 was most sports and fantasy sports. And then 4 was a strategic choice on when I was and wasn't going to be available for the family. Because it's really easy to be like, oh, I'm doing this for the family, so I'm just going to spend all my time with the family. And so it's setting up those boundaries, because it's like everything you say yes to, you're saying no to something else. And so for me, I wanted to know what I had to sacrifice. And to me, it was just like all that stuff really, really wasn't worth it. Like all that kind of downtime. And so for me, I replaced 8 p.m. to 10 p.m. at night with 4 to 6 a.m. And to me, that was like one of the greatest hacks. I would just go to sleep with my kids like at 8 o'clock. And then turns out after 8 hours of sleep, it's already 4 o'clock in the morning. So my body would just kind of naturally wake up, because I would always like eat junk food, watch shows for 2 hours, right? And I was like, just replace that, and then 4 to 6, do the miracle morning. And I was like, you do that for 5 years, like I'm a different human being.
Yeah, that's great. That's a lot of great information there. Thank you so much for sharing. So, Adam, how can our listeners learn more about you and your different businesses?
Sure. So email is great, adam@homeequitypartner.com. You can visit the website, homeequitypartner.com. You can send me a text, 701-404-9137.
Okay, awesome. Adam, thank you so much for coming on today. I appreciate you sharing all this information with what you're doing out there and, changing lives, and looking forward to connecting with you here in the near future.
I love what you're doing here on the education piece, and hope you get some good karma coming your way.
Thank you. Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.